Hello, my name is True Demon, and I'm the Devil's Stockbroker. Thank you so much for tuning in to watch this video. Before we begin, please understand I'm not a financial advisor, and none of the following content is financial advice. The following content is for educational and entertainment purposes only. Trading stock carries inherent risk, and you should always respect and understand your own personal risks when considering any investment. Please don't take what I say as gospel, and please do not trade based on the information that I receive and share through my content. Thank you so much, and have a hell of a time in the stock market. Hello everybody, my name is True Demon and I'm the Devil's Stockbroker, and today I'm going to be updating everybody on what the market's been doing this past week and give some forecasts for Friday's close as well as things to look forward to in the following week. Before we begin the video, I wanted to remind you please to leave the video a like and subscribe if you're not already a member of the channel, and consider joining us at Hell's Trading Floor for all the market education and leads on new investment opportunities in the market that you could possibly ask for. Alright, with that out of the way, let's get started. Starting with the broader market, we've got the SPY here in front of us on the daily chart. And what we are currently seeing on the SPY's daily is that after being rejected off of this top here at $410 earlier last week, now we are currently trying to fight for air at around $390. The day closed at $390 just today and has been wicking through that area all throughout the trading session today, as well as in after hours, which you can see is now bringing the SPY down to $387.70 currently. The big question on everybody's mind is what is the market going to do next week, and what can we expect based on what we've seen this week? So first off, it's been a really volatile couple of days. Looking back at the hourly chart, we can see that the SPY was giving people some little bit of hope after it had gapped down pretty severely on Monday, and after we had formed this bearish dragonfly candle at around this would be 1 p.m. Eastern time on the SPY on the 13th of September, that's Monday. The SPY quickly sold off from that point and never really looked back. We've had quite a bit of chop all throughout the trading sessions from Tuesday and today. But we started off pretty strong in the morning before we had this big red-bodied candle that brought us all the way back down to $392 or thereabouts. SPY's been chopping around throughout the rest of the afternoon session until after around 2 o'clock. Then it finally started to sell off, and it tried to fight for air right around 390 before selling off into after hours. So currently we've got a few things to take a look at for the SPY's technicals going into tomorrow. So it almost looks as though the SPY is beginning to form a bit of a wedge while it's trading in this bull channel. That is a channel that's moving to the downside because they tend to break to the upside. My estimates, however, were that this is actually part of a much bigger pattern that's been forming over the last couple of weeks that honestly haven't really been paid much attention to. From what I can see, nobody's really been talking about this, but the SPY has actually formed a very large inverse cup and handle. When you look at the SPY on a clean chart, we can see that we had this head and shoulders that formed and then completed going into the first week of September. We know about that. However, when you look at the overall pattern here and you draw a huge arc, you notice that we have formed what is ostensibly known as a cup and handle, but inverse. So it's upside down. And what these patterns tend to do is once they break the baseline of the cup, that would be the rim of the cup, they break further to the direction in which the trend is going. So very much a bearish pattern where I would expect to see the SPY trading all the way back down at around 375 at any point between now and the end of October. And we can get better confirmation of this because we see that the MACD has now crossed to the downside on the hourly chart, showing continuous bearish momentum to the downside after a very brief period of upward momentum with a sideways MACD. Basically a big signal of consolidation in the price while we looked for resistance and then were quickly forced into a sell-off. 388 marks a significant area of resistance for the SPY, particularly if we were to draw a supply zone around this consolidation channel. We can see that there's a big range of area where the price oscillated before we went on this recent run going from July all the way up until about mid-August. So we can expect to see the SPY chop around this area for a little while, but more than likely what we'll see to start with is that the SPY will make a very fast move to the downside and find support down near the bottom where the chart had first established its support here. So seeing how the SPY, once it had hit a bottom down here in June, it immediately made a run for the top, and it only took about maybe 2.5 trading weeks for it to find this area of resistance, and then it bounced back down to support. So in the similar fashion, we're kind of expecting the SPY to do the exact opposite move from this period. The SPY will cut straight through to the bottom of this area of supply, and then find some demand as bulls try to hold up the market. Now, there's a big problem with the bulls thesis in this case because we have FOMC coming up, which is going to include a Fed rate hike decision. And this is what everybody in the market is watching right now, waiting to see, are the Fed going to put in another 75 basis point hike? But now people are talking about, is there the possibility of a 100 bips hike? Just to illustrate the difference, for those who may not pay attention too much to what the Fed does, the rate, or the federal funds rate, that is dictated by the Fed determines the amount of cash that is transacted between banks in interest. And this causes ripples throughout the market. It makes transferring of funds and lending to become very expensive the higher this interest rate goes. Over the last several years, we've been at a very, very low effective interest rate, or an effective federal funds rate of less than 2%. And during the COVID crisis, they brought this down to what was basically zero. It was pretty much free money that the Fed was able to allow banks to transact back and forth, and lending became very cheap. This immediately had an effect of creating relief in the market as financial organizations were able to lend out capital to companies that needed it in order to prop up their businesses, make necessary business purchases, and keep things going while we went through the pandemic. But now, because of that action, it's led to a massive oversupply of money in the market, and amongst, I don't want to say that everybody is suddenly rich, but there's suddenly a whole lot of credit and a whole lot of debt just spread out to everybody, where average consumers received a bunch of cash without high interest attached to it. And now that policy is being reversed significantly. And because of that, we're seeing this entire sell-off in the market as they fight inflation. And it's causing all this confusion. The volatility in the market is a direct result of every single factor that affects inflation. For example, we saw first thing in the morning, there was a big increase in the number of retail sales, which you would assume that means a good thing, that retail stores are performing better, that they're selling more. But this is actually not a good thing, where the market is seeing more sales in retail stores, and they're seeing the direction of those sales are pointed towards necessities, and those sales are targeted toward extremely sticky areas of inflation, and it's causing the prices of those goods to rise. And the retailers are benefiting from inflation because they're able to charge more for their products and services. And because they're continuously doing that, and because the demand for those goods is still there, people are beginning to mentally adapt and accept that those higher prices are there to stay. This is what the Fed refers to as sticky inflation. And it's creating a very detrimental effect in the market, because every time that retail sales do well, every time that there's a indication that a certain sector is doing well that targets consumer cyclicals or consumer necessities, the consumer not consumer cyclicals, but consumer defensive stocks, those essential needs, those goods and services like food, drink, household and personal services products, things that people have to use or people purchase on a regular basis because it's a necessity. Those defensive sectors, while they perform well, the rest of the market continues to sell off as they anticipate more aggressive action from the Fed in the form of raising interest rates. Now, there's a few other factors to pay attention to here. Over here we have Europe. Okay, this pound symbol is going to represent the currencies of Europe. This also includes the euro, as well as the Australian dollar and a few other currencies, but we're just going to focus on European currencies and just kind of put them under a blanket. Over here we have the US dollar, okay, and what I'm going to represent is what's currently been going on in the market. This orange graph is going to show you the DXY, that's Dixie, or the dollar index. The dollar index is a basket of currencies that are tracked against the US dollar. So in this case, the currencies that we're speaking of are the top 6 currencies that include ones like the British pound and the euro, tracked against the strength of the dollar. When you see this graph going up, it means that the dollar is becoming stronger or more inflated versus the other currencies of the world, which are going down in value or weakening. Now, this has created some confusion because normally people think, oh, strong dollar, that's good. That actually means inflation. Stronger dollars mean that it costs more to use the US dollar. The value of the US dollar is going up versus other world currencies. This, in the world currency sector, makes it attractive to invest in the dollar. And by doing that, that creates more investment in the US dollar, or it locks the dollar in, and it entices other world currencies to exchange their currencies for the dollar instead. What this translates to in the Forex or the currency market is the dollar inflates while the foreign currencies that are being exchanged deflate. And the thing is that currently the Fed is fighting inflation right now. The reason why they're having such a hard time is because they printed so much US dollar supply and injected it into the stock market that it hyperinflated the value of stocks and equities. At the same time, the entire world around us has been going through a recession. They've already accepted that recession is here, and they have been fighting their own inflation at the same time. World inflation altogether was going up, meaning that all currencies were basically strengthening at the same rate. So Dixie, Euro, and the entire world currencies essentially were more or less going sideways. Like, notice how during COVID, Dixie was going down. That's because there was big inflation happening in the external markets, and the dollar was weakening versus the European currencies. But that's no longer the case here. Now we're having the opposite effect, where the dollar has massively outgrown the other currencies in the market. This is making it more and more and more difficult for the Fed to do its job, and this is creating a bit of panic. Up until the COVID pandemic, the dollar had been strengthening over time, but as we started to see the stock market near its top, the dollar began to strengthen pretty severely. And after the Fed decided right in December, January of 2021 that they were going to start tapering their monetary policy, meaning increasing interest rates, this immediately caused the market to decline. Meanwhile, the dollar was racing ever higher. These are now becoming inverse of each other. Whatever DXY does is going to create the opposite effect in the SPY, the stock market. This is because dollar is becoming stronger, i.e. more attractive. It's less attractive to be in equity, and inflation is causing goods and services to become more expensive for average consumers every single day. Let's also take a look at US oil. The orange line now represents US oil. US oil has been strengthening in value because the costs of production had been going up all throughout the pandemic. Now, ideally, for the sake of the economy, the market would like for oil to continue to go down. If oil goes down, that means that it's going to create less pressure on inflation, causing inflation to rise. When oil becomes cheap, that means gasoline becomes cheap. And gasoline is a huge driver of inflation because you need it for everything. You need it to transport goods and services. You need it to generate electricity. You need it to lubricate machinery. You need it for literally every industry that we have. Oil dictates cost to businesses. Right now, oil has been basing at around 85. There was anticipation that it was going to break down all the way back down below 80, maybe even hit $70. But right now, oil is starting to see a base, and something important just happened recently where President Biden has alluded to placing a floor on the price of oil in order to sustain oil imports to the US because it's, quote, good for the economy. The big change and the reason why I think that oil prices are about to skyrocket is because of a new change in Biden's policy where he's going to look to basically purchase oil from companies and reduce the OPEC supply by adding to the Strategic Petroleum Reserve while prices are below $80. Honestly, Biden, and I agree with this article when it states that Biden's energy policy has been just a series of contradictions. Biden's administration is, quote, considering buying crude oil to refill the Strategic Petroleum Reserve when prices drop below $80 a barrel, according to NYMEX near-month futures, which are just under $90. This is not a complete surprise. Almost 140 million barrels, or 24% of the supply, have been drained from the SPR since March, when the International Energy Agency agreed an emergency release in response to Russia's attack on Ukraine. Meanwhile, the Department of Energy has proposed modifying its procedures for refilling the SPR, including the use of fixed-price contracts for future delivery. What this effectively means is that Biden is putting a limit buy on oil effectively. Anytime oil becomes effectively $80 or less, the government is contractually going to obligate itself to purchase that oil and take up that supply. That is going to reduce supply in the market and sets a guaranteed floor price on the market. This is actually going to have the opposite effect and cause prices to rise because it will give investors confidence in the energy supply to start buying back futures contracts in oil that guarantee them a better price. And when oil prices rise, it's going to cause inflation to also rise. So these are all several factors that are going to add to the inflation problem and is going to factor into the Fed's decision. So, what is all of this information going to translate to into the market? Again, I'm going to focus on the SPY and the FOMC minutes that are going to be upcoming next week. So FOMC is going to be announced, the Fed rate hike decision is going to be announced at precisely 2:30 by the Fed Chair Powell on Wednesday, 2:30 p.m. Wednesday. The decision from the minutes are going to be released at 2 o'clock. So that's going to be the moment where all of the algorithms look at the minutes and make a decision of what's going to happen to the market. What I think is going to happen is I think that the Fed is going to be backed up into a corner. As I mentioned in the previous section regarding the different currency pairs and their competition with the dollar, it's important to know one very important thing. The dollar is weakening because the dollar is getting stronger because all the other currencies have gotten ahead of their inflation problem. The euro and the British pound specifically, they've already added as much interest as necessary to get ahead of their inflation. Currently, as it stands, the foreign markets for the British pound have already priced in a 100 basis point hike for their currency. They are already doing everything necessary to attack their inflation problem and get ahead of it. And they've already done at least one 100 basis point hike in the past. The thing is that all the other currencies and all the other nations, they've front-loaded their inflation problem. They took care of the issue before it became a bigger issue than it was. They actually took the drastic response earlier when it mattered. And because of that, they are able to better compete with the strengthening of the dollar, and this is making the Fed's job harder. This is literally a race between all the different nations' currencies to see who is going to be able to hit the sweet spot of raising their interest rates fast enough to fight inflation, but not too fast as to crash their economy entirely. And honestly, it's a losing race. It's like driving at 100 miles per hour towards a brick wall and seeing who hits the brakes at exactly the right time to stop within a foot of crashing into it. The chances that you get this right are between slim and none, but the chance that it goes catastrophically wrong gets way worse the longer you wait, because if they don't speed up enough and hit the marker to fight inflation, then it's going to result in the economy collapsing anyway due to the runaway inflation. But if they don't, if they go too hard, it'll result in a collapse of the economy, and we can see another Great Depression. And that's what the Fed is fighting with currently. But for the first time, I think that they're going to actually have to consider a 100 basis point hike, because they're going to have to do one sooner or later. The dollar is moving too strongly, and they've not gotten ahead of inflation. The latest inflation print showed that it's not under control. While the PPI printed slightly lower in the past week, we saw the CPI printed much higher instead. So consumer costs are rising while manufacturer costs are basically break even. But the thing that the report didn't actually show, and what wasn't explained in the highlights, is that the only components of the producer pricing index showed was that the costliest and the stickiest forms of inflation in the form of building materials and goods and services was actually rising. So the phase 3, phase 4 products, final products, are what are actually rising in cost. So no matter how you look at it, the cost of the final goods and products that are coming out and being priced in the producer price index as well as the consumer price index are all still going up. So inflation has in fact not peaked yet. All that being said, here's what I think is going to happen. And please keep in mind that this isn't financial advice, and it's very difficult, extremely difficult, to perfectly map out what the market is going to do on any given day. I'm going to give it my best shot. Please take this with a grain of salt and make sure that you do your own research and conduct your own due diligence before following any of this. This is not financial advice. Given the moves that we've seen in the market as of recent, and the fact that we know that right now we are about ready to break to the downside on a cup and handle, this is what I think is going to happen first thing tomorrow. I think that we're going to see continued selling going into tomorrow, and eventually on Friday, we're likely to see a pop right at the last minute at the end of the day. The FOMC minutes is going to be announced on the 21st of September at precisely 2 o'clock. That'll be 11 a.m. Pacific time. And I believe that what we'll see in the market is continued downside, possibly slightly neutral, maybe a little bit of volatility. Right before the minutes meeting, I'm anticipating a huge rise in the price to challenge the previous resistance, somewhere between 387 and 390. Right after the minutes meeting comes out, especially in the event that a 100 basis point hike is announced, if they shock the market now, then it's going to cause mass panic and we will see a rapid decline in the stocks. And I believe at that point, it will be just blood in the streets. If we receive the 75% basis point hike instead, we are still likely to see some downside, but the market may need to chop its way down lower throughout the rest of September until the first week of October. This is the chart based on seasonality, which shows that during Democratic president's second midterm, second year of their term, that's midterm elections, the market tends to see a significant decline in mid to late September up until early October. So based on that seasonality, that's what I'm anticipating the stock market to do. Based on my current charts, I still think that the market has a pretty far way to fall. If we get the more severe case where they surprise us with a 100 basis point hike, we could see the market sell off as far down as to the base of this average trend line, which has been tracking the direction of the market overall. This is based off of the tops and the average trend line of the stock market so far since it reached its top back in January of 2022. So if we do end up seeing these lows, that could see the SPY dropping as far down as $340 before October. This is an extreme scenario, but given what we've seen with the turmoil in the markets, the uncertainty of the economy, and the Fed's constant bumbling, not being able to actually fight inflation, and how literally nothing has gone wrong as far as their economic policies and planning, it's very possible, in my opinion, that we'll see one of the fastest declines since the Great Financial Crisis. However, this isn't something that you should bet on with everything that you have. This isn't how you play these types of plays. What we should be looking at is different sectors to see how we can play this market and look for the areas of greatest weakness to play to the downside, look for areas of strength to act as a hedge, and continue to stay diverse in this market, because right now bear markets, especially this one, are going to be probably one of the most dangerous that we may see in our lifetime. So assuming that we see the completion of this cup and handle and we do get the 100 basis point hike, my opinion is that we'll see the SPY collapse down to new lows on the year before we enter October. And we may even continue to see some selling throughout October. So plan accordingly and be prepared for that. The sectors that are likely to be the hardest hit is going to be tech sector, consumer cyclicals, consumer durables, and of course, the housing market. What I have on my screen here is the XLRE 1-hour chart. XLRE is an ETF that tracks the real estate sector specific to housing and commercial in the United States. This sector is, it's been pretty consistent in how it's traded. We've seen it track the SPY pretty closely, but lately it's been doing continuous sell-off while the SPY's been chopping, and we can attribute this to continuous rising numbers of housing listings, as well as declines in listing prices and overall decline in existing home sales. These new numbers are also going to be coming out next week on Wednesday morning, coinciding with the FOMC minutes, so we can anticipate that those numbers are going to be bad. Right now, the stock market is doing pretty poorly, but the housing market is in full free fall now. We are now entering into phase 3 of a housing crash, which starts the point where panic begins to ensue and investors start to look for ways to liquidate their assets. Home builders and real estate investors are trying to get out of their properties and try to move to cash as quickly as they can without ringing the alarm bells. But we're seeing it reflected in the way that listing prices for homes are coming out onto the market, and this is having a dramatic effect on the REITs that depend on house sales to continue to do business. This is resulting in a massive decline of 7% in XLRE in just the last 3 trading days. So right now, this index is doing very, very badly, which is good for me and good for Hell's trading floor, who have basically been swinging puts back and forth with each opportunity, staying out of the way of the rips and then looking for opportunities to go short on and follow those dips all the way down to new lows. The latest trade on XLRE, we watched this head and shoulders develop and then played this to the downside, caught this double bottom, waited for the upside rip to end, and then entered in as soon as it rejected off of the 200 period moving average on this 1-hour chart, which you can see right here. As soon as we hit that, we entered into puts and got in for this downside swing, which we are still anticipating will have a little bit more room to go, all the way down to $38 before we exit October. Throughout the rest of the year and going into next year, we still anticipate the housing market to continue to perform extremely poorly and result in a whole lot of liquidation of assets in REITs and home builders. In addition to this, there's also the NAILS ETF, which tracks home builders. The NAIL ETF has been doing equally poorly, dropping almost from $41 down 41% to $24 just in the last month. This has been a huge decline for this ETF. If you're looking to go short on home builders specifically, such as D.R. Horton, Lennar, Pult Homes, this is an ETF to track and go bearish on. As you can see, this ETF has performed extremely poorly since the beginning of this year, down 83% from its start in January, all the way from $125 down to $21 at its latest low point. If you had gotten leap puts on these, you would have undoubtedly been up more than 500% on any leap put that you had bought close to the money here, and probably even further than that. It's really hard to say exactly how far it would have been, but say an $80 strike put or a $100 strike put going out until January of next year, you would currently be about $60 in the money from your strike. I personally don't think that this is done selling off. The housing market, and especially the home builders, are still in for a lot of pain, and we're likely to see quite a lot of liquidations of assets and continued losses once the Q3 and Q4 numbers come out for all of those home builders. So for those, I'd also be looking to go short on stocks like Lennar, which are currently down about 17% since the middle of the last month. As well as D.R. Horton, which is also down 15% since August 16th. And you'll notice that each of these home builders are still pricing in quite high on their stock chart. We can expect to see a lot worse conditions for them going forward into next year as it becomes harder and harder and harder to sell their inventory of homes. Of the tech giants that I'm targeting to see more downside going into next year, Apple is definitely the biggest one. Apple is currently the heavyweight on the SPY as well as on the Nasdaq. This results in them creating a tremendous weight on those particular ETFs. Once pain in the rest of the market begins to basically cause forced liquidations of major funds and investment firms, Apple is going to be one of the last stocks that they sell. So as a result, Apple tends to hang around the longest out of all of the major stocks on the SPY. But once it finally lets go and we start seeing liquidations happening in the market, we're going to finally see Apple being liquidated, and we're going to see stock price declines, bringing us all the way back to historic lows on the stock. At the moment, Apple, financially speaking, is still in great shape. They have reduced their costs, they've cut employees, they have reduced their expenses, and they are taking care of their cash needs ahead of time by selling corporate bonds, which are rated AAA, the safest bonds that you can get out there. And they're only one of 4 companies in the United States that actually have AAA rated bonds for their corporate bonds. It's a rare statement. So financially, the company will remain in good shape. However, once we start to see those liquidations hitting the market and other funds starting to go bankrupt, this stock is going to drop fast once we start seeing those stories printing. And honestly, we'll probably see the sell-off beginning before that even happens, because those funds becoming liquidated, we don't hear about it until at least several days, 2 weeks after the fact. So all of that selling is going to start happening before then. Right now, Apple is looking pretty weak as it is. The stock has basically printed that same inverse cup and handle that we were looking at earlier, showing that all of August was a huge rip and then a massive wave to the downside, followed by a brief rally and then a retracement, which now we have gone back to the midpoint on this cup. what we can anticipate is Apple will eventually return back to these previous lows here at around $140 to $130. Will that happen before October? We can't really say. For me, I would be betting on Apple to go short over the next year if possible. It's expensive, but the additional time is well worth it. And if you're able to get several contracts going out that far, then it's an extremely attractive investment, particularly because the entire market is depending on Apple to hold it up, and the market is continuously getting weaker and weaker. Also, some of you might find this surprising based on what Tesla's been doing, but I'm actually going short on Tesla right now. My reasons for doing this is because right now I don't think that the market is accurately pricing in the actual costs for Elon. Even if he gets out of his Twitter deal, is not going to result in any major gains for the company. It's merely just status quo for them. Fundamentally, the company's situation hasn't really changed. Now, I love Tesla as a company. I think that they're a great long-term investment, but given the market that we're currently in, I think that Tesla is way overvalued up here at $310 post-split adjustment. Now, it's trading down to $300 in after hours, but I'm anticipating Tesla to go even lower in the near to midterm. That would be between the next couple of weeks to 3 months from now. On the technical side, Tesla had created these this three top pattern on a descending line of resistance, and I'm starting to see the same thing happen here where we had a top, top, and another top. Now, Tesla is broken below this top again after touching, and you would be tempted to think that this is a bull flag overall. However, what I'm seeing is we've actually had a two-touch top, that's a double top pattern here, a decline, and then an attempt to break out above that level again. Now, we failed here at $309, which was not able to break these highs. Now, because Tesla was not able to get back above these heights, I'm anticipating Tesla to return back to these lows, at which point we will either see a double bounce and complete a double bottom on this chart pattern. We could see this form as a double bottom on the daily chart, or Tesla may end up actually breaking through to the downside, at which point we would expect to see Tesla return to previous lows along this trend line. In addition, with other tech stocks, I'm currently short on Nvidia, looking at the way that the chart has been shaping up and also considering the current situation with China. We can anticipate that Nvidia is going to continue to trade to the downside. Now, the thing to be careful with is that this is trading in a descending wedge right now, and Nvidia is a bit it is a bit undervalued in my opinion. It's returned to its pre-pandemic heights, or excuse me, no, I withdraw that entirely. It's returned to its mid-pandemic highs after it had ran following the COVID announcement. And part of what I'm anticipating is that Nvidia will continue to trade down in this area, trying to find support along this line. And if it isn't able to hold it back up, then we'll see Nvidia return back to pre-pandemic highs here. My Microsoft chart has basically been, it's basically followed my arrow perfectly. It does look like it has a little bit more downside to go sometime around 242, but at this point, Microsoft has sold off so significantly and followed this trend line almost perfectly that I would actually I'll be thinking about taking profits right about here. We'll see what happens after the FOMC minutes, but at this point, this trade is already so deep in profit, like I'm not really worried about it and can continue holding it for several months. Google is currently nearing the bottom of its chart, which is looking like it may be able to form a little bit of support here, but again, we need to wait to see what happens with FOMC minutes to see if Google does in fact bounce at this level. If Google does bounce at this level, I'll be looking for another short opportunity somewhere in this price range, around $110 at the most. I still think that Google will probably continue to move with the market to the downside as things get harder and harder economically speaking. However, if the FOMC minutes does prove to be extremely bearish, then we can expect Google to sell off with the rest of the market. If you're not very comfortable with picking out specific stocks to go after, then you can look at the Nasdaq, which is very tech heavy, and you can also trade the Qs, which both of these are essentially the same. The Qs track the Nasdaq, which is just the index. But looking at the Qs, you can see that the chart is forming a big head and shoulders on its daily chart. Let's go ahead and clean some of this up a little bit so that we can see it a little easier. This head and shoulders pattern is starting to work out beautifully. We've just closed below the neckline. So as a result, we can expect the Qs to continue to sell off, going back down to retest its previous lows this year. This is the first set of take profit levels, so if you're short for the short term, meaning between now and 3 weeks from now, then you can look at taking profits at around the 280, 270 level on the Qs, or you can go long on SQs and look to take profit at around the $60 level. Keep in mind that SQs inverses the Qs, so it does the opposite of whatever the Qs does. So if you're going short on the Qs, you would want the same bet would be going long on SQs. If you're looking to go short directly against the SPX, that's the SPDR index, you can buy calls on SPXU in the same fashion. Currently, I have take profit levels at $21 going out till mid-October. And for my short play on the real estate market, I'm actually going long on DRV. This is the bearish 3 times leveraged direction shares against the real estate market. Going long on this index is basically doing 3 times the opposite of whatever XLRE does. So if you want to go short on the housing market with leverage, then this is the index to go for. Currently, however, DRV is approaching my first take profit here at $51. If the stock continues to touch this level and maintain its level going into the existing home sales data release, I will anticipate DRV to continue to the upside all the way through September and October, where my next take profit level is up above $60. Keep in mind that I have positions going out till November, so these are pretty long dated. They are expensive contracts, and I did enter much earlier. As soon as we bounced off of this 200 period average, that was when I entered into my position. So you have to keep in mind that I'm already well within my position, and we had a 3 white soldier pattern right here, these 3 green daily candles that printed back to back. It essentially put me instantly in profit, and now I can hold these with almost no fear. My cost basis is already taken care of itself, so this is a riskless trade for me. If you're going to get into this, please bear that stuff in mind and make sure that you're only trading according to your risk to reward and your risk management strategy. If you don't have a risk management strategy, you're doing it wrong. And ending on the bonds, where all else fails, look to the bond market to decide on direction of the stock market. Whatever the bond traders on HYG, that's the high yield corporate bonds ETF, this is a basket of bonds targeting specific companies. These are poorly rated, non-investment grade bonds. So this is basically just as speculative as the stock market in terms of how bonds are traded. So if you see HYG going down while SPY's going up, that tells you that bond traders are bearish on companies while the SPY is bullish. And it's historically true that bond traders tend to know better than stock traders. So if you start to see SPY going up, if SPY go up, HYG is going down, then trust HYG. HYG has statistically been more accurate as to what the market is going to do. And you can use this to your advantage going into the FOMC minutes meeting. Pay attention to this stuff. Look at what HYG is going to do ahead of that meeting. Place a little marker right at 2:30 p.m. That's 11:30 a.m. for me on the Pacific Coast. Pay very close attention to this line and pay very close attention to what HYG is doing and put SPY on the chart with it. Make them both lines and watch these lines. As long as they're moving down together, then you know that the stock market is just as bearish as the HYG market. But if you start to see SPY going up and HYG continues to go down, then that tells you that whatever the SPY is doing is a lie. You should not trust the SPY when it starts to go in the opposite direction of whatever the bond traders say it's going to do. So pay very close attention. If you start to see, if you feel your emotions tugging at you, if suddenly the SPY starts ripping to the upside going into the FOMC minutes meeting, check the HYG bonds. Put your emotions in check, put that stuff aside, pay attention to what the bond traders are doing. If the bond traders are nervous, if the bonds are going down, you see HYG going to the downside, then that means that the SPY is wrong, and you should use that as a sign that the stock market is wrong, and this is your opportunity to enter into some puts at the top of the SPY. Also pay attention to the yields on the 10 and the 2-year bonds. Blue is the 2-year yield and the orange is the 10-year yield. Currently, these bonds have been moving up pretty much the same. You would also, these are also the bonds that dictate the 10 and 2 yield curve, which as it turns out has been deepening in its inversion. I can show you that in just a second. But take note that if the stock market is going up, then the bonds should be going down, or the yields should be going down. If you see the yields going up and the stock market is also going up, then the stock market is probably wrong. This is again a case where you see bond traders getting nervous. When yields are going up, that means that the value of the bonds is going down because they are inversely related. So naturally, what bond yields are doing should be the opposite of whatever the stock market is doing. It's not universally true, but in times where there is indecision in the market and you start to see the stock market just ripping to one direction or collapsing downward, look at the bonds and see if they're correlating. If the stock market is going up while the yields are rising, then that means that the stock market is probably wrong. That's going to be it for today's video. I hope that you found this helpful and it gave you some strategies that you can look to in order to aid your own trading. When in doubt, consider coming to Hell's Trading Floor. Our team is more than happy to talk with you through strategy, and we broadcast every single day. We share trading tips, and we're constantly talking and looking for opportunities in our voice chat. You can join us at discord.gg/Hell's Trading Floor and join us through our website at hellstradingfloor.com. Thank you guys so much for watching, and I look forward to seeing you tomorrow at the bell. Have a hell of a time in the markets.